All right, welcome to the weekly meeting, June 10th. June 10th, all right. Man, we rocking and rolling. Halfway through the year. Hopefully everybody's trading is to their liking. If not, you got a half a year to fix it, you know. It doesn't take very long, you know, believe it or not. You know, if you tweak one or two things, maybe get the car back on the road here if it's rolled off the road for you. You know, but hopefully everybody is at least, if you're not getting the results, you're seeing improvement. You know, this is a zero-sum game. You know, you're either performing or you're not, you know, and there's a lot of times there are there are very small things that take us from being a winner or from being a loser to being a winner. And you know, I'm just from my little one-on-ones with people, and you know, my conversations with people, I think we need to continue to beat home market structure. I think for the most part, that's the part that we're struggling with, or it's not yet clicking. You know, because structure is everything. You know, whether the market is going up or down, whether the move is likely to continue going up or going down, noticing the breaks and the swing lows, or you know, following the trend from the higher time frames. So I think that's where I want to keep the focus at least for another couple of weeks. And what I would like to do is, you know, I know those of you who have been in this group for a minute, we've seen the market structure series by Pips of Persia. We've seen Smart Risk, you know, here lately, you know, about market structure. I want to go back to the first video with the Pips of Persia. And for those of you who've seen this video before, you're probably, and hopefully you will, you'll get more out of the information, you know, because you've been trading, you know, and you've been at these charts. Maybe you've been tricked a time or two, but maybe something that he says the second time around will give you, or have more meaning, a different meaning, a stronger meaning. Maybe you'll understand it more clearly. But that is the goal. For those of you who are still losing, you know, I would like to encourage you to trade a higher time frame, right? Trade less. And here's what I mean by that. If you trade a higher time frame, we tend to start at the weekly and try to trade both directions, trade the pullback and then trade the move. If you choose a higher time frame, like the 2-week chart, it's going to force you to use less trades, right? Because once you enter the trade, it's going to take longer for that trade to play out. And generally speaking, if you understand the direction on a 2-week chart, you're not going to get fooled, right? It's going to go that direction. And it might be a slower trade, but the amount of pips will increase, right? And the likelihood of you gumming that up is a lot less, because you might not even have to touch the trade. Like I didn't have to touch my EJ trade. So I would just encourage you, if you're having problems, if you're not getting the results that you're looking for on the lower time frames, sometimes it helps to trade a higher time frame, you know, for the reasons I just outlined. I don't know if it works for you as an individual, but it's just a suggestion that may be an added benefit to whatever you're doing, you know, as a trader.
Trading, being market structure, even.
Alrighty. Let me back this up.
Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face, and I hope you're catching pips as usual. Pips of Persia here. In today's video, we are going to start another mini series on market structure to little by little help you all have a great understanding of the most important element of trading, being market structure. So if you get value from this video, make sure to press the like button down below. If you're new to the channel, press the subscribe button. Welcome to the family and welcome to the community. But before we jump into it, before we even speak about market structure and go through some of the basics of it in this video, first things first. Structure is perhaps the most important aspect of trading and analyzing the charts. A good understanding of market structure will elevate your trading game beyond your belief. Believe me when I say, even if you think you know market structure, even if you think you know exactly what it is and how to trade it and how to identify your trends and trends within the trends and break of structure and all of this, believe me when I say you are still going to get value from this series. But without further ado, let's go ahead and jump straight into it. And let's first speak about some of the most basic points when it comes to market structure. Now, chances are, if you're watching this video, you already know about a bullish trend and a bearish trend. You already know about low, high, higher, low, higher, high, or high, low, lower, high, lower, low. But very quickly, I'm still going to go through it just in case there are people that are struggling to understand what we mean when we speak about a bullish or a bearish trend. The idea behind trading is you always want to be on the same side as the trend. So if the market is generally going up, you want to look for buys. If the market is generally going down, you want to look for sells. But the question is, how do we identify if the market is generally going up or generally coming down? The best way I can describe this is think about it from the perspective of stairs. So if you have staircases that are going up, it's going to look something like this. And if you have staircases that are coming down, it's going to look something like this. And this is exactly what the market structure or the trends within the market actually look like. If the trend is going up, hence it's a bullish trend, then it's going to be similar to the steps going up. It's constantly going to create new highs or higher highs and new lows that are higher than the previous lows, or what we call higher lows. And if the market is in a bearish condition, then it's the other way. It's the steps coming back down. So it's continuously creating new lows and new highs that are lower than the previous high, hence why we call it lower high and lower high and lower high and so on and so forth. And you've heard us speak about break of structure a lot as well. So in this specific case, let's say this level over here, once the market broke below this structure level, that's what we consider a break of structure, because in a way we would expect in a bullish trend for the market to continuously create higher lows and higher highs. So if the market in a way doesn't create the higher low and go to create another higher high, and instead creates a new low lower than the previous major higher low, then now that's a break of structure to the downside. But as we all know, this basic understanding of market structure is really not enough for us to be able to become profitable traders. So let's go into a little bit more detail about the fractals, or about seeing lower time frame structure alongside of the higher time frame structure. For example, if you are seeing this picture maybe on the 4-hour time frame, on the hourly time frame or 15-minute time frame, you are going to be able to see smaller trends within this trend. So you'll be able to see trends going up within one major move of the larger trend. So instead of it just being one major move, on the lower time frames, you're able to observe smaller steps. And this is what we have drawn over here, where you can clearly see that the blue line is the higher time frame trend. In this case, I haven't drawn a proper trend. I've just shown kind of a 3-wave bullish trend and a 3-wave bearish trend, just to be able to show you in theory what we mean when we speak about fractals. So if on the higher time frames you've got this bullish trend, on the lower time frames you're able to see these trends within the trend of the higher time frame. And you might ask, what do I mean by higher time frame versus lower time frame? That's relative. It depends what higher time frame you're looking at and what lower time frame is going to be relative to that. So it doesn't have to be from daily to 4-hour, or from 1 hour to 15 minutes, or from monthly to, let's say, the 4-hour time frame. It's a relative higher time frame and a relative lower time frame. And what I mean by that is, on whatever time frame you're able to identify the bigger trend, on a relative lower time frame, a time frame that's at least half the time frame that you were initially looking at, you will be able to see these smaller trends in the middle. And I think this is where a lot of traders get confused, because on the daily or 4-hour time frame that identify a bullish trend, and when they go to the lower time frames, they'll see a bearish trend because they'll be seeing the smaller time frame market structure. And this really throws them off whether they should be looking at buy positions or sell positions. So consider this scenario. Let's say you've analyzed your chart, you can clearly identify a bullish trend, and maybe even based on other factors that you have, you expect the market to have another impulse to the upside. So the very final thing you'll end up observing is this low, high, higher low, and higher high. And based on this, on the higher time frames, you're more on the bullish side, and you expect for the market to give you a little retracement, being this dotted line back down, for the next impulse to get ready and for you to be able to trade this next impulse to the upside. But then you'll go to the lower time frames, and now you're able to see the lower time frame trend as well. So you'll end up observing this bullish trend within the larger time frame trend on the lower time frames. So on the higher time frames, you can see this as one major swing to the upside, which I'll speak about a little bit later as well. And on the lower time frames, you're able to see this little step-by-step move. So you'll end up trusting that structure as well. You'll end up wanting to trade based on the lower time frame market structure. And where traders get really confused is when on the lower time frames they would be able to see something like a break of structure, where on the lower time frames you might see that the market has now broken below the lower time frame bullish trend. And this is where things go wrong, because as soon as traders observe this, instantly they would consider this a break of structure to the downside, and therefore they would expect this to continue going lower. And this is probably one of the scenarios that you have traded before as well, where you want to buy it, but you'll eventually see a lower time frame break of structure, and you'll end up trusting it. Once it broke structure to the downside, maybe you were trying to go ahead and sell it over there, or maybe waiting for another pullback to look to sell it. And before you know it, the market has another rally to the upside. And now you're confused, thinking, hang on a second, this just broke structure. How comes it just had another rally to the upside? What I'm about to say right now is the entire point of this video. Just because lower time frame breaks structure does not mean higher time frames will follow. Exactly what I've written over here. And take this into consideration as well. For the market to break structure on the higher time frames, so let's say for the market to break structure on the 4-hour time frame, first we need to see a break of structure on the lower time frames. So before it breaks structure on the 4-hour time frame, it needs to break structure on the 1 hour, it needs to break structure on the 15-minute, it needs to break structure on the 1-minute time frame. But just because it gives you a lower time frame break of structure, this does not mean that your higher time frame trend will also respect that. And what I mean by that is just because over here it's broken below the lower time frame trend, by no means this is an indication that on the higher time frame we are going to reverse as well. For us to be more confident about higher time frame reversals and more swing trade positions, then we need to see higher time frame breaks of structure as well, which would be somewhere around here in this case. So although in this example it's broken below this minor structure point, it's not considered a major break of structure if you're looking to trade the next major swing to the upside. This whole thing over here can be considered a pullback, and you always have to pay very close attention to where the major swings in the market have taken place. Where have we had a major swing, a major move in a given direction? And probably the best way that I can help you out with it is what I've written down here. When marking up structure points, it's important to know where in the market have we had a major swing. The low and the high point of that swing will be your trend points, and the smaller moves in the middle are your lower time frame structure points, where we have had the major swing, the low and the high of the swing points being the major structure points, and the smaller moves in the middle being your lower time frame structure points. Simple as that. Now, enough theory, let's jump on the charts and let's analyze GBP USD and see exactly what's been happening with pound dollar in terms of market structure. So truth be told, I can go into so much information about this GBP USD example and start it off from the monthly and the weekly time frame and break it down, talk about where we've manipulated and why we were expecting a bullish move and all of these things. But instead of doing that, I just want to focus on what this video is about, which is the major structure point and what has been taking place. So I'm mostly going to be focusing on the 4-hour time frame and below in terms of what I'm going to be speaking about right now. And I'll start it off with an example from some time ago, around April last year, because I believe this is one of the most perfect examples to be able to show you exactly what I was speaking about earlier. So let's say you're on the 4-hour time frame and you're able to now identify this low, high, higher low, higher high. So generally speaking, you can see the start, at least, of a bullish trend on the 4-hour time frame. Now that we can see the higher time frame trend, we also now want to pay attention to the lower time frame trend as well. So I'll put this in replay mode, and then we can have a look at how, in a way, the market has been reacting and maybe even quote unquote breaking structure, yet it still continued to have the next bullish rally to the upside. So check this out. These 4 levels are your 4-hour structure points. However, when I go ahead and zoom into the hourly time frame, I can go ahead and identify the smaller structure within this major trend. And the example that I'll give you is here. This is now our major swing to the upside, and the smaller structure points is low, high, higher low, higher high, higher low. I'm not going to take into consideration all of these small waves. These are lower time frame structure. Generally, that would be the higher low, higher high, higher low, and probably your final higher high. So now this is the smaller trend that's forming within the larger time frame bullish structure. And this is where a lot of people get confused, because traders would go ahead and identify this as their last major swing point, either over there, or they'll go ahead and identify this level, for example, as their last major swing point. And let's say this is what they're observing in the market now. So they don't even see what's happened after that. They see the 4-hour impulse, they see the smaller time frame waves in the middle, and they go ahead and identify these as some of their major structure points. And once/if the market breaks below these levels, they would anticipate and they would look for sell positions to the downside. Now, I'm not saying this is not the right thing to do, but it depends what type of a trader you want to personally be. And the reason I'm saying this is, of course, if you want to be more on the intraday perspective or scalping perspective, by all means, you'd indeed be able to take these sell positions to the downside based on the smaller time frame break of structure. But what I'm trying to tell you is, just because it has broken structure over here, in no way this is an indication that this market is now going to come down here and break below the major 4-hour structure point. This can very well be a retracement and eventually go back up. And this is exactly what took place in this scenario as well. Let's take it off replay mode and let's come back to where we were looking at. This is exactly what we can observe over here as well, where in a way on the lower time frames, you can see some type of a break of structure to the downside. However, the market still ended up reversing and over the longer period of time ended up going higher. Although it ended up breaking structure on the lower time frames, the move to the downside was not a long move, was not a major move, breaking higher time frame structure points as well. And even though it created a perfect looking bearish trend as it started to retrace, it still was not enough confirmation for us to now want to trade against this, for us to now want to, in a way, sell it to the downside. Again, scalping and intraday, that's a different story. I'm more of a swing trader personally. And when we go back up to the 4-hour time frame, you can now see exactly what we were speaking about earlier, where you have your low, high, higher, low, higher, high on the 4-hour time frame. This is now your next higher low. I'm going to just identify this as the major higher high up there. But you can see that within the same higher time frame trends, you have these lower time frame trends as well. And this is clockwork, by the way. You'd be able to see this over and over and over and over and over again. In fact, I'll go ahead and focus on this final impulsive move that we have had on the 4-hour or the daily time frame. So the final major impulse has been from this low to this high. Now, I've highlighted this specific area, so I'm going to be speaking about this area a little bit more, as I believe this would have been a perfect scenario for a lot of people to look to sell it, yet instantly they would have hit stop loss. Now, you might identify the hourly structure points slightly different to how I'm going to draw them right now. That doesn't necessarily matter too much as of right now. I just want you to be able to see the general major structure points from the low to the high, higher low, higher high, higher low, higher high, higher low, higher high. This is majorly the hourly swing point. So you can go ahead and put another higher low over here, another higher high and another higher low. But either way, that is the major move that has been taking place on the hourly time frame. Let's go ahead and put this in replay mode and let's bring it back to right here. If this is now my major hourly trend on the lower time frame, such as 15-minute, 10-minute, 5-minute, you will be able to observe all of these little moves that are taking place as your smaller time frame trends. I'm not going to spend too much time going through them right now, otherwise we'll just keep going to the lower time frames and identifying structure points. I want to speak about something that's a lot more important and about how to not be trapped in positions like this. This level over here probably would have been a very attractive level to identify as a major structure point, as a major swing or a major reversal point in the market. And the expectation would be, if we break structure below there, you can expect sell positions. You can expect that the market is now going to reverse and come back down. But remember what we spoke about earlier. Just because we break structure on the lower time frames, it doesn't necessarily mean it's going to follow on the higher time frames. So on the 4-hour time frame, you knew you were bullish. On the hourly time frame, you knew you were bullish as well. So if it hasn't broken below the major hourly or the 4-hour points, you should not be looking for sell positions. This sell position, however good it looks, is invalid. Yes, I see that it's created a bearish trend. High, low, lower, high, lower, low. Yes, I see that this came up and mitigated this final institutional candle. So the risk to rewards would have also been phenomenal. But again, it depends what type of a trader you want to be. As an intraday trader, by all means, this would have been a phenomenal scenario to want to be taking this to the downside and perhaps target these same lows or maybe this inefficiency over here. But as more of a swing trader or someone who wants to be in the position slightly longer, you have to pay attention to a little bit of a higher time frame structure points. So this would have been a no trade scenario until we started to challenge the major hourly or the 4-hour structure points to the downside. And then I would have looked to sell it. Simple as that. Even for those of you who are trading intraday, the same thing does apply, just on different time frames. You still have to pay attention to the relative higher time frame based on whatever time frame you're initially looking at. So let's take this off replay mode so I can speak about a couple more examples here on GBP USD as well. This swing is another perfect textbook example where you can clearly see that from this low to that high is our major hourly time frame swing. However, on the 15-minute time frame or 10-minute time frame or whatever it may be, you can see the low, high, higher low, higher high, higher low, higher high. So you can see the trend within the trend. But just because it's broken below there, does not mean this is a trend reversal sign, because it's still contained within the previous higher time frame major swing. It's still a retracement in a way of that massive impulse to the upside. And this is where you have to develop your patience properly for the market to, in a way, tell you what it's ready to do. Because sometimes it will break the lower time frame structure points and then reverse, and other times it won't. And the example that I'll give is exactly the next swing that we have had over here. And the first swing, it broke the lower time frame structure points, then had the next impulse. However, over here, this is our impulse. This is the lower time frame low. We can put that as high, higher low, higher high, higher low, higher high. In this specific example, it didn't actually break the lower time frame structure points. It respected the lower time frame structure points, so it created another higher low, and it went ahead to create another higher high. But more than anything else, what I want you to take away from this video is do not identify any random level as your structure point and expect the market to completely reverse in its trend just because it's broken a random structure point. So I hope that kind of makes sense in terms of applying the theory of what we just spoke about to the actual charts, to be able to make a little bit more sense of it, to see what I mean when I talk about the smaller time frame trends or the fractal trends, and also what I mean when I speak about the lower time frame break of structure versus, for example, the higher time frame breaks of structure. But here's the thing, this is not all about structure. There's still so much more that goes into market structure, hence why I've decided to record a series rather than just one long video. So this first video was more of an introductory video for market structure, for everyone to now be on the same page, for us to know what market structure is, what a bullish or a bearish trend is, be able to identify the lower time frame structure points. And what we're going to be speaking about in the next video is specifically how to utilize the lower time frame structure points for your entry confirmations. So we're going to be speaking about how you can, in a way, know when this retracement is finished forming. And this is also another huge topic, in my personal opinion, when it comes to trading, because as long as you know you're in a specific trend, if you know where this pullback is going to stop and reverse, then you're a profitable trader. So in the next video, we are going to be speaking about this. We're going to be speaking about how to utilize the lower time frame trends to confirm your positions. And in the future videos, we'll speak about how different concepts like Wyckoff or smart money concepts can be used alongside of this for better analysis. So stay tuned about the next videos coming out. There's still so much more that we need to go into, but I'm personally looking forward to recording those videos, and more than anything else, I'm looking forward to seeing each and every single one of your breakthroughs utilizing these concepts properly. So if you got value from the video, do make sure to press the like button.
I definitely got value. All right. I think that is probably what I've noticed is the biggest issue with the people that I've talked to. And, you know, I can't stress this enough. You know, whenever we start talking about analysis, there's always going to be an issue if this 4-hour time frame is where you started, right? You're not going to see everything that you need to see from this 4-hour time frame, right? But you can manage trades from this time frame if you're a swing trader. You know, if you're a intraday trader, you can manage from lower time frames. If you're a scalper, you can go even lower than that. But everybody's analysis needs to start from a higher time frame than the 4-hour, right? At the minimum, you know, I think you need to look at the weekly, because the weekly is going to tell you what to expect for the week. Then you can break it down after that. And one of the key points, you know, to me in that video is, if you know where we're going, you know, on these higher time frames, if you have an idea of where we're going, then you can mark it out on the chart, you know, so you'll understand. You know, I used to have a video, or I still have the video, about framing the market, right? If you mark those areas up, it'll keep you in the box, you know, per se, as far as what you're expecting to happen during that week. And then you can take the weekly, you know, moves, and you can take them, you know, you can mark them on your chart, and you can take them, you know, into your analysis as you break down what you expect to see. You know, how far you expect the pair to go, what still needs to be accomplished. Then you notice where your imbalances are, or your order blocks, and all that good stuff. I would just encourage people, you know, all of us as traders, to not be complacent, you know, not feel like we've reached our destination, and just to treat this like this is a continuous journey. You know, when you go back and you listen to, you know, different you know, videos and different podcasts, and you hear people speaking on this, you know, you're going to get a lot more out of the information with the more experience that you have. And, you know, again, from my conversations and interactions, especially over the last couple of weeks with you guys, this is the biggest issue I think that most of us are facing, is not understanding what needs to happen, or where we are in the move, you know, on the higher time frame. So whenever I look at a chart, you know, y'all know I go way out, you know, and I can just kind of run the move down over the course of time. And then I can pick my trade setups based on the 2-month, the 2-week, you know, the weekly, the daily. But a lot of people are having problems when it comes to understanding where we are on the move and what needs to happen, right? So I would just encourage us to use these time frames, you know, especially if you pay for your membership to these, you know, to TradingView. Use the time frames, like put time frames that aren't listed on your sheet, you know, because sometimes, you know, if you look at the 4-hour, it's not going to show you everything you need, or the picture is still going to be fuzzy. You might need to see a 5-hour chart. You might need to see a 6-hour chart. And if you're, you know, somebody that trades those lower time frames, maybe the 15-minute isn't clear. Use 18, use 21. But you have to create these time frames for yourself. If you ever find yourself confused when you're looking at a chart, go up, look up a time frame, because most of the time, if it's fuzzy on your time frame, if you go up another time frame, it will clear up a bit, and you'll understand, okay, this move is just retracing, because we broke this structure. We broke this structure. The move is pulling back. Maybe I just need to throw the fib, from the top to the bottom and see where we're pulling back. Then when I get my levels, whether it's the 50, the 75 or 78, I can go over to the left and see maybe there's an order block, maybe there's an imbalance, or maybe this move is going to correct higher, right? But you have to use the higher time frames in order to kind of justify your thinking. The worst thing we can do is just say, well, I think it's going to do this. No, man, you have to have some rationale, behind your thought process, and then drop your ideas into the group. That way, other people can kind of look, and maybe they will give you a difference of opinion. The benefit of getting a difference of opinion is not so you can be right. It's so you can have the information. If that trade goes against you, then you can say, well, such and such said that trade is probably going to short and I missed something, but at least you're not blinded by the move. All right, do you guys have any questions, any comments, any contributions? And then there was silence.
So Todd, let's talk about the different time frames for a second. When you're using the different time frames, like you said, most of us use the weekly, the daily, the 4 hour, the 1 hour, and the 15 minutes. So say I tend to use the 3 hour a lot. So you know how we're moving down from time frame to time frame. When we're looking at those different, what am I trying to say? When we're looking at these different time frames, when you're moving down to time frames to get your position, like, how do you know where to go? Like from the weekly, we know we go to the 4 hour. So if you're on a 3 hour chart, which one of those major time frames do you go to get your position? Or would we fall back in line and go to the 15 minute or the 1 hour, etc.?
So I think what you're asking me is, if you are on the 3 hour and you see a trade set up from the 3 hour, you want to get your entry. If your setup is on the 3 hour, your entry is 2 time frames lower at least. Right. So if you're on the 3 hour, I want to enter probably on the 15 minute, maybe you can create a 10 minute or a 12 minute, but at least 2 time frames below. And that's another thing, right? Your setup is on the 3 hour.
Right.
And your entry is on the lower time frame. Where you manage your trade will be that lower time frame too. So this is what I mean by that. Here's a move, right, on the 3 hour, right? And you got an order block right here. Let's say you see the bullish order block form and you want to wait until the price comes back down here for your entry. You can set up your tool, your position tool, for a long position. I'm just going to set it over here. Maybe this is the area that you're interested in. It's a 30 pip move and you're taking it, I'm just going to say, to this high, right? This to be a 7% trade. You want to go and you want to set your alert above your entry, because you don't want to wait until your trade hits your entry. You want to wait. You want to have an alert set. Maybe it says look for buys right here, whatever you want to put right here. Now, this is going to pull back at some point. You can't run and jump in the trade right here because you see another bullish order block. Let it do its thing. Don't chase price, because if you buy right here, you're buying at the top of structure. You're buying high. You're not buying low, selling high. You're buying high, and it's going to pull back on you. So eventually it's going to come to this area, and it's going to give you a buy opportunity. And if it doesn't, it's not your trade. Don't worry about it. It's not your trade. So if you entered this trade on the 3 hour, right? And you manage your trade from the, let's create a time frame. Maybe I have to delete one of these. Okay, I already have it. I already have a 10-minute time frame. So let me go to the 10-minute. So let's just pretend that where I have my entry, that's your area where you want to manage your trade from. And you entered down here. Trade went up, it pulled back. Maybe you want to add another position. This is you managing your trade, right? I don't know if you guys add positions or not, but eventually you'll get to that point. Trade pushes up, it pulls back, you could have added. It pushes up, it pulls back, you could have added again, right? Maybe you're saying, okay, I want to get 2 positions in every trade. And the benefit from that is once you're on these lower time frames and you get this bullish order block and you add, the levels of your stop losses are so small down here. Maybe you want to protect this wick right here. That's a 6 pip stop loss. And if you're taking this trade up, this one move right here is 11%. This is you managing your trade on the 10-minute, but your setup was on the 3-hour. Does that make sense?
Yes, it makes sense. It's just choosing, like you said, the time frame to go down to, because like you said, we have to go down 2 time frames. So when you on one of the odd hours, the odd time frames, like how do you know which to go down to? But I understand what you're saying.
So it's 2 hours. Let's it's 2 hours that you want to drop. So it doesn't matter where your trade setup is, your entry and your management should happen 2 time frames down. Anybody else? Brett. So everybody's comfortable with structure.
Hey, Todd, I have a question. So if you're entering on the 2-week time frame, it means your trade is going to play out in 2 weeks.
No, that's not.
Yes, we don't know how long the trade is going to play out, but we're safer on the 2-week time frame. It's a little bit confusing for me.
All right, here now. Let's talk.
Why is it?
Okay, I'm trying to get my question. The question is, if I'm entering on the 2-week time frame, along the East Coast, seeing, I don't have any how long the trade is going to play out is not under my control, but the 2-week time frame gives time, gives more time, or I don't know how to ask this question.
Individuals and people with underlying lung and heart conditions. For these individuals,
It gives more time for the trade to play out.
It gives more time for the trade to play out, but it necessarily doesn't mean it'll play out in 2 weeks.
That's correct. But so sometimes you're just going to need a more clear picture, right?
People's bodies during lockeye explosion. So the short term.
Maybe I'm going to mute you because your TV is loud. But maybe your time frame, maybe your time frame is not clear. And here's what I mean. When we came into this month, right, on this NJ trade, all I had was this gravestone doji, right? Gravestone doji means that the market has reached exhaustion and it's probably going to sell from here, right? I already had a bearish monthly order block, right? Everybody see that? In fact, I'm just going to throw this in replay mode so y'all can follow what I'm saying. Okay, this is what I saw at the 1st of June. Y'all tracking? This gravestone means to me that the market is going to sell. But here's a gravestone doji. I mean, you got a lot of these candles exhausted right here. So my point is, I want a more clear picture than I can see with the gravestone doji. So at this point, I can hit the 2-week chart. And instead of showing me a gravestone doji, now I have a bearish order block. And you might not be able to trade a gravestone doji, but you darn sure know how to trade the bearish order block, right? So what do I expect from this when I trade this bearish order block? When I drop down to the 4-hour, inside the bearish order block that I just highlighted, I see a massive imbalance. A massive imbalance. This gives me, as a trader, the advantage. Now I understand, whenever somebody says, hey, let's just take Alicia, for example, because Alicia is good for saying, well, it's got to feel the imbalances in that wick. Well, what the hell does that mean? I don't know about an imbalance in a wick. Maybe you don't, maybe maybe this is your first time hearing somebody say that, or maybe you've heard it repeatedly, but you've never really had the courage to ask what imbalance in the wick. So instead of looking at this monthly candle and somebody telling you that we need to feel the imbalance in the wick, if I just drop down or change my time frames and get a picture that I'm used to seeing, and then drop down to see what's inside this order block, now I can see the imbalance in the wick. And I say that with air quotes because this is exactly what Alicia is always talking about when she says it needs to feel the imbalance in the wick. So now I understand that trade needs to move from there up here to the imbalance in the wick. And I want you to think about this. This was 10 days ago, right? If you look, this is June 10th. 10 days ago, this was the exact picture that I saw. So if you, as a trader, would have understood how to clean that picture up, now this presents a beautiful trading opportunity, because there's a bullish order block right here. There's imbalance that needs to be filled right here. In theory, I have a trade set up that's 262 pips. And I have a protection area where I can set my hedge for 24 pips. That is a 10% gain. That is a passing challenge. I don't know how long it's going to take for price to get up here, but god dang it, I got 30 days on most challenges. And some of the challenges, I got limitless time. So this gives you the advantage. Now, the reason you use a hedge is because maybe price wants to play jackass and go take out this low right here. I don't know, but the idea is solid for the trade to push up, right? And this will give you the advantage over the market. Or maybe you don't want to hedge, right? Maybe you're just so scared of the hedge, you want to pull your stop loss to 50 pips, and you're only going to get 5%, but you're savvy enough that once the trade starts pushing your direction and pulls back, you can drop down to the 15-minute and add a position, and you're still going to pass your challenge. All of these things, right, that I'm speaking to you right now are very easy to do if you understand market structure, right? And you understand what you want to see and how to get that picture on different time frames. So in theory, when this trade takes off, we're going to get an impulse move. We're going to get a pullback. The pullback is not going to be quite as low, right? And then it's going to impulse move up. That's in theory. So let's just kind of play this trade out and talk about some of our options. So there's a pullback. Okay. So if you notice the pullback, we got everything we wanted. Our number one objective was to not get kicked out the trade, right? We want to be a part of this trade because we know we guaranteed 5%. Now let me delete my move. If you notice that this push up, the impulse move up broke the highs, which is exactly what we wanted to see. So this is the point as a trader where you have to be able to go in and use your fib, right? You want to fib this impulse move. and you want the pullback to come to your zone. And in this case, the trade would have left you high and dry in your zone, but at least you know what it is. And maybe, I mean, you're not going to chase it. You're not going to chase it because there are going to be plenty of opportunities. Maybe it'll come back in the next candle. Boom. The trade hits your zone. When the trade, remember, you would have set your alert right here. So when that candle would have hit your zone, you could have dropped down to the 15-minute. You would have dropped down to the 15-minute because you'd have saw here, and then it would have faked you out. And then bam, it drops down, it picks you up because this was your zone. And you was listening to me that one weekend when I was talking. You would have had your second entry, and there would have been a 7 pip stop loss. I like to use 10 myself because 10 is plenty. You know, I mean, let's not be ridiculously greedy because we only need the qualified challenge, right? So you extend this trade, you can take the trade from here all the way to the top, or you can just get your 10%, right? You see that's 15%. And we'll just play it out and see see what happens. We know the trade still needs to pull back to clear this imbalance. So if it runs back on you, don't get scared. And it's like watching paint dry when you replay this on this. I'm gonna go up to an hour.
Or you can speed it up at the down there at the bottom.
About time you told me something, Kim. Okay, so y'all see this plays out perfectly. My point is this. We all have this skill. Now, the problem is we don't all have the wherewithal to apply these skills, right? You hear me say it, or you hear Kim say it, or you hear whoever's up here, whoever's talking to you, they will say it, but you have the technical knowledge to understand what we're saying, but you do not have the tactical knowledge or the ability to apply what you've been told like 1,000 times. And this is what's preventing you from making a boatload of money, because I just replayed a scenario that everybody in here was capable of executing, right? Everybody in here, I mean, y'all may not have understood how to go to the 2-week chart and pick your trade or clear the picture up, but now you know. Once you see it, you can't unsee it. But all of us have seen trade setups where we thought we knew where price was going, right? You get your initial entry. Once the initial entry bangs up and pulls back, you're waiting on it. Like, the reason why I could drop to that 15-minute chart and wait for it like an ambush is because that's exactly what it was. It was an ambush. The trade showed itself when it pushed up and broke the highs. Now I just threw the fib on it, and I'm gonna sit and wait like I'm picking up third graders, you know, with a pocket full of candy. You know, this is too easy. It pulls back right to your spot, lets you in the trade. I mean, if there was any imbalance down here, you know, it was an order block. That's really why I like to use 10 pips. I would have covered that order block because all I need is enough to qualify a freaking trade. And remember, I got my first position, which I don't get a good, you know, a lot of money for, or a lot, you know, but a lot of percentage for. But this second position is I'm gonna have a bigger lot size, and it's going to qualify my trade if I just execute it. I don't have to rush it. I don't have to get all nervous and bull crap. I'm just executing a trade, something that's going to happen because it's how the market works. So hopefully, you guys, you know, when you see this, this is not like mind blowing. This is just like what happens. Shut up, Terrence. But I mean, y'all understand the point, man. Like this is at some point we have to exercise the advantage that we have over the market, right? Like I use the kid in the candy store scenario because it's like once you understand what's going to happen, it's really like that. Like we're the adults. We pick and choose where we want to meet the market at. The market doesn't pick and choose where it's going to bully us to. And if it doesn't, like if this pullback didn't hit our zone, okay, I'll wait. It broke high again. I'll set my zone up again. It missed it again. That's cool. I'll wait because it's going to do this the entire trip up, right? So you don't have to stress out about catching the market. You set the trap, either the market walks into the trap or it doesn't. That's cool. I'll wait for it to break the next high. That's
Hey Todd,
yeah.
hey, as someone who's been trying this a long time and not been able to find the success, due to my own mistakes. But if you go back to that 4 hour and even on your 15 minute, I think this particular one, you get faked out on the 4 hour move a little bit. So I would have got a hedge picked up right there. And I probably would have been out of shape about it. And then on the 15 minute, I think it did the same thing. So I think
Let's talk about why would you have gotten the hedge picked up?
so. That 4 hour bullish order block.
Which one?
The original one was
right
like
what?
25.
Okay, yeah, this one right here. The original before this red kind of pushed down.
Right.
But
And then
wait, let's talk about this.
All right.
Why would you have set your stop loss right here when you understand that there's a low and liquidity that sits right here? This is a conversation that all of us should think about. The reason I told you is I'm looking left. I'm looking left. I see this low. I know we took the liquidity right here. This order block is a little higher. Heck yeah. I mean, there's a strong possibility we can dip. We could even go down to this low. But there, even if like ICT always talks about the market setting up. So I know I have an understanding that this is going to be a long-term sell. So I would not have been at all surprised if we had came down and made a double low right here, creating relative equal lows for when the move comes back down. This is how I'm thinking as a trader. This is how we have to train ourselves to start thinking, because the market is going to set itself up and it's always creating the liquidity. So I would never set my stop loss right below this candle because it's too easy to get kicked out, especially on a move that we have 262 pips available to us, T. We have to be bigger than this one setup, because our initial entry into this trade, we should look at this as just getting into the trade. Once we get into the trade, man, we can position ourselves all kinds of ways to make money. But you can never start making money if you don't get into the trade. This is very important. What's that?
Okay, so with this one, you're saying that you can move your stop loss to the bottom of this wick once you see that the 4 hour created the order block above the MAs. Am I saying that right?
I
Closed
didn't say that. I
the
didn't say nothing like that. I didn't say anything like that. As a matter of fact, I want you to how do I get this replay back without killing it, Kim? How do I bring the replay, but how do I bring it back? Like this? Okay.
And then there you go. There you go.
Okay. So this was the original setup, y'all. This was the original setup. When we looked at this on the 2-week chart before we got any movement, this was on the 1st of the month. Y'all remember it? Let's go back to the 2-week chart. This was the 2-week setup. We dropped to the 4-hour, remember? And on the 4-hour, I said, hey man, on the 4-hour, we can see a clear imbalance. We already have a bullish order block. We can take a trade up here. And we measured that it was 262 pips, right? I didn't mention anything about moving averages or any of that stuff. What I said was, and I understand what you're hitting on, TT, but at some point you have to not only understand, but you have to trust your analysis, right? So on this 4-hour order block, I'm not waiting for price to cross over. I'm not. This is the beginning of what needs to happen. I understand that price needs to retrace. This is how many candles before this order block? 2 candles before, the market showed me that it was exhausted. This is a hammer candle. You know, if you read your candlestick Bible, this means the market wants to go up. This is the same level that's been respected. There's a swing low right here. It's been respected. The market is exhausted. We know where it needs to go. That's been our bias, you know, for forever. It needs to come up here, and then we think it's going to sell. So I understand all of these things, right? So all I'm looking for is an opportunity to take this trade up these 262 pips. So it's 262 pips available to me, and I can make 262 pips dance. All I have to do, though, is get into the trade. I can't make the pips dance if I'm not in the trade. And I don't want to guarantee myself that I'm going to get kicked out the trade. I want to guarantee myself that I'm going to get into the trade. So I want to set my entry at the order block. And I want to use a fatter stop loss. I don't want to have my stop loss right here. I'll use a 50 pip stop loss, right? Just so I can get myself into the trade, and I can cover this if in case price comes down here and wick this low. That's what I said. I didn't say nothing about moving average or any of that. I got it that the price is on the wrong side of the moving average, but
Can I add something too?
Yeah.
For Terrence's question, where he said he would have gotten hedged. So even at this point with the bullish order block, and because Todd is a more aggressive trader than me, I would have waited for, if you can go down to the 1 hour or the 15-minute, maybe the 15-minute would be better.
You wait for this.
I would have waited for, no, you see the high over by the end? No, yeah, right. Yeah, right there. I would have waited for price to break that high. Well,
I don't think.
no. Let me rephrase that, because price went down, pushed up, went back down, and then started breaking structure to the top side. So that last swing high, that last swing note over a little bit.
Over here?
Yeah, I just to answer his question, I probably would have waited for price to break those highs. Down a little bit. Right, yeah, about right there. I would have waited for price to break those highs. Some people would consider that wick that broke that high as a break of structure.
Clearly a break.
Right about a P.
Yeah,
No. Let me just say, because I'm talking about my strategy, right? I'm waiting for a candle close above, because anything like it did, it went up and sold back down, right? And it sold back down into an order block that's over there to the left. You see what I'm saying?
You mean this
You
one?
see the order block, right? Yeah, right there. So
yeah, but that's all
price
happened before you got your order block.
But that's what I'm saying. So once price went down and then started breaking structure to the top side, the then I would have said, then I would have gotten into the trade without getting either my hedge or stop loss.
Okay, I mean, that's cool. That's cool. But on this trade setup, in order it's easy not to get a hedge picked up because you see where your structure is. The market is at its exhaustion point. You see the wick and you have the order block. The only way you can get picked up in a hedge is if you hug this order block, because this low right here is where the liquidity is. And if you want to, the next level of liquidity is below this low. So if you just use a 50 pip stop loss, it's still a 5% trade, guys. I mean, 5% ain't bad. But
Oh, this is great. Keep
Yeah.
going, Todd. So just walk us through what you see, because even the next candle makes a bearish 4-hour order block. So what are you thinking?
So no, it's a liquidity grab is what it is. That's what the next candle does. It goes down and grabs liquidity. Exactly why I wanted to give it room. It did exactly what I thought. Liquidity grab, because it's a wick, right? Liquidity grab, bam. Then it immediately breaks the structure. Immediately breaks the structure, right? You see how it broke the structure? Immediately. After it grabbed the liquidity, it immediately breaks structure to the top. It's a no doubter at this point. It's no doubt that it's going high. It took the liquidity, breaks the structure, you throw the fib on it.
Where's your structure break? Is it the second green candle or that first one with the wick?
Look, it's right here. This was your structure. This green candle was the top of your range right here. That green candle.
Gotcha. Okay.
So if you can put a line on this, I'll just move this line down. I'll move Kim's line down.
Don't do Kim like that.
No, I'm just gonna use that same line. It comes and grabs liquidity. It immediately goes up and breaks the structure, right? It goes a little bit higher and it pushes down to pick you up. Bam. This is where you got picked up. And as soon as you get picked up, you break all the structure. You see that? That's to me, the setup was so picture perfect and so clean. You got everything you wanted to. And the fact that it broke this it broke the moving averages. This is where Kim would have came to play, right? This is where she said she would have had her position, which is cool, right? Because I tell you, you can wait till you get the candle close above the moving average. There's nothing wrong with that. But eventually y'all will get to the point where you'll see the move happen before it breaks over, right? There's nothing wrong with playing safe, but I'm just showing you how it could have been done. You understand what I'm saying? Like this to me was the perfect setup. The exhaustion, then the order block, the 2-week bearish order block. So we know it's going to sell. We know that this is just going to push up to close the imbalance, and then we're going south. I already know all of that. I have all the information from those higher time frames. I was just trying to show you why and how I would have gotten in for this entry, for the move up. Now, to be fair, I've been in this. I did in this move. I didn't get the second entry on the lower time frame because I'm trading too many accounts. But the point is, it was there and it's available to you. And this is how I do it every time. It's not any tricks or any gimmicks, right? I don't care about my first entry. My first entry is most of the time it's going to be well under leveraged, because the opportunities once you get into the trade are so enormous and so vast. Man, you can get all sorts of high RR on these trades because you just drop down to that 15-minute. Especially, you want to wait for it to break the structure first. Wait for it to break new structure. And then you sit on that pullback, man. You can get all kinds of RR every time.
Okay, so Todd, let me ask you this last question and I'll leave it alone. So you remember You remember we had got in the EN buy one time and then it sold like 200 pips.
Yep, I do remember that.
Is the difference between that and this is where the liquidity is?
Well,
Uh,
there's a
because when you
there
get
are
the
a
four
couple.
bearish on this, you're not concerned about it selling. You know, I'm just saying I would have been like, okay, there's a 4-hour bearish order block. This could sell a while first.
Hey, Todd.
There's a big difference.
Todd,
What's up, Sean?
you're right. There is a huge difference in it. I'll just answer it, Terrence. The difference is, you know how we started on the 2-week, and so you knew it was going to sell because we started this analysis on the 2-week in this scenario.
Right.
I think in that other trade, we were down in the weeds on the 4-hour and did not look up high enough. So we never saw the sell coming, you know, so that's why we always say
That ain't it, because I would have never did that. It
I
was
think go
it
ahead.
was a week. It was something on the weekly chart that had us taking it up. I don't know if it was a
Right.
retracement.
No, it wasn't on a weekly chart. It was that it ran for a week, right? It had sold, I don't know, man, maybe 400 pips the week before. And we were guys planning it. And that 15-minute chart broke towards the moving average. And it never went. It just kept going down. So this is totally different because we have that 2-week order block telling us that it needs to push up before it pushed down, right? I guess news could hit or something could prevent it from closing this huge imbalance. But the fact that we're anticipating this selling for, you know, I don't know, 700 pips. Is that what you got, Kim? I'm trusting Kim's pip count, you know. But because we're expecting the bottom to fall out of this NJ trade, and we had pinpointed this area for weeks, you know, we knew that it was going up. So in my opinion, this setup was totally different than your EN setup. So if you would have waited for it to cross here, I mean, that's cool, right? I don't mind that at all. That's a less aggressive move. I mean, it's a less aggressive entry. It's still going to accomplish the same thing. There's nothing wrong with you waiting. I'm just telling you and showing you how I would have got in, and I gave you my reasoning based on the chart. And you can see my setup played out just like your setup will play out if you choose to get in after that. Does that make sense?
Yes, sir.
I don't know. I haven't did the math after. Let me see. Let me just throw this fib on here and just see if you would have got picked up on a pullback immediately. And you know, to be honest with you, if I do a one-on-one with you, I'm gonna tell you to wait for this to cross anyway, because that's gonna keep you safe. You know what I'm saying? But that's not how I'm doing it. You know, I'm going to enter whenever I see my entry.
MA save lives, save
Well, they
account.
do. Well, see, in this case, MAs would have prevented you from catching all them pips. But maybe to come back.
You can't get every trade. That's okay.
Hey, that's cool. I mean, every trade you're not going to catch. So you wouldn't have got an entry here, but you would have got an entry on this one. You would have got an entry when this pulled back.
I might have got it touch
For
that
sure.
wick.
Well, you would have definitely got this entry.
Yeah, for sure.
And that's what I mean. Like, you can't chase price, you know, and if you miss your entry, you know, be a little upset, but trust that the trade is going to come back. Because this came right, it came, you know, once it gave you this wick right here, it came right back down, bam. You would have gotten this trade. Of course, you might have been pissed off because it came to the 78, but it eventually went your direction.
That's how you keep your accounts.
Yeah, but you know, I mean, my entry was perfect. You know, I mean, you know, however you see it or however you trade it, in my opinion, is not a wrong answer. If you would have waited for it to cross, that's cool, right? If you would have caught it when I caught it, that's cool too.
I'm
But
just saying until we get to that level.
yeah, that's
You know
cool.
what I'm
Like if you're
saying?
not comfortable taking the trade based on what you see, you're always going to be safe when it crosses the moving average. This is where you want to be on the right side of the moving averages.
Yeah, and I think it's still only like a 30 pip stop loss if you put it at the top of that 4-hour wick
Right
and
here.
just cover that whole OB. Yeah, if you know lower where Kim's red line is, if you put your entry there.
But yeah, listen, there are definitely ways that you can enter this trade with like off of the 4-hour. Like if you had just targeted the area that Kim highlighted, you could have definitely got an entry in this trade. And you could have put your stop loss like anywhere down here, like at these highs. You could have had an entry and a stop loss. There's nothing wrong with doing it that way. But you know, when you say stuff like this, I think people have a tendency to get confused because they'll be like, well, there's no order block right there. I know, but it's a sell stop or a buy stop, you know, that you could use and you would have got picked up in that. But you know, it's just there's a million different ways that you can trade or set your trade up. I don't have control over that aspect of y'all's trading. Like I think that there is strength to trading your comfort, right? But the problem that I have with some people is you change it up. You know, if you're going to do something in trading, it needs to, you know, you're not going to find, you know, a great deal of success if you're not consistent. You have to be consistent. Consistency is what's going to pay you over the long run. You're going to lose some trades being aggressive. That's how it works. I get faked out every now and then. But the difference is I already see where I would take the trade, right? Like I'm not going to just lose 1%. I'm going to get my money back. I don't have a problem sitting in a hedge. If it's not an accelerated account, you can sit in that hedge for a whole month before you have to, you know, pay for it or whatever, because you get 30 days to trade. Even accounts that you get paid every 14 days, you don't have to take a payment if the money ain't right. So my point is, you could hold that hedge all the way, you know, you can hold it up and down the chart. It don't even matter until it comes time to get paid out. So if your hedge had gotten picked up, you know, and you had got discombobulated, once the price would have crossed over, then you would have known it was going up, right? So you could have started, you could have started cutting your hedge at that point. There's 1,000 different ways that this could have worked out for you. You know, I just showed you the way that I would have entered on that 15-minute. I was already in the trade, you know, when it pressed up and came back, I got in and I was cool. But I didn't get a second entry in this NJ trade. I had a couple of entries in the EU trade. But I'm a dog the NJ trade, you know, once it gets up here to this imbalance. Anybody else? Rare. Terrence, you
I
had
have something to say.
yes, ma'am.
I personally have been finding a little success, if I can just speak on myself. Being a woman, we tend to be a little emotional. So, and the market is emotional. But I'm saying all that to say, I've found a little success just by first trusting my analysis. If we trust it, put the sell limit or sell stop in or buy stop the opposite, I've walked away and left it alone. And I found success in that.
I think that's huge. You're right, because if you sit there and watch the charts, you're always going to see something different. The charts are ever changing. If you've done your analysis and you set your position up, it's either going to win, lose, win or lose. Let it play out. You see it for a reason. I mean, you come to these classes, you hear all the information. So it's going to either play out or it's not, but be comfortable. Like if you manage your risk and say, hey man, I'm a risk 0.5% because I don't really trust my analysis. Let it play out. Give it a chance to prove you right or prove you wrong.
But that's the big part, the risk part. We definitely have to make sure we're managing our risk. When you put that first position in, or when I put that first position in and walk away, it's really low. Because you don't, you have to give it time to play out. Once it play out and start going in the blue, or wait for the next pullback, then you add to it. And
can you say that again? Please,
for me,
your first position is what?
Really low.
Mine is too in most cases, Angie. I mean, I walk into most positions. Walking into positions is the best thing that I've done for my trading. And here's what I mean by that. Even when I'm 100% right, what good does it do for me to lay a huge lot size on a trade that I'm using a 50 pip stop loss when I can wait until it proves me right, and then I can add 13 lots on my next entry. It makes sense to walk into your position. Once you get in there, you just wait for the next break of structure and pull back. And every time I'm in a trade, I'm always going to get my re-entry or my second position at least on the 15-minute. Sometimes it could be the 5-minute, but I don't ever press lower than that. Like I know Leandro be getting entries on 1 minute. The 15-minute is plenty for me. A 10 pip stop loss is plenty for me. And it will be for everybody, most people in here, who because you're probably not making the money like that yet. But a 10 pip stop loss does wonders for your bottom line. But you just have to have confidence, once you get in the trade, you have to understand what you're looking for. You're looking for breaks and retests, right? When it breaks structure for the next and it pulls back, that's when you want to get your next position, and then you want to catch the impulse move. When it pulls back again, you want to wait for it to go up and break. Once it pulls back, boom, you get in for the next impulse move. So on this level had to be broke first. So when you see this market goes up and breaks right here, your fat entry is right here at that pullback because you broke this level. Now you get to ride the heavy lot size up to this next level. That's all you're looking for as a trader. That's where you're going to get your big money from, and that's where you're going to become a better trade manager. And the breaks and retests should come from the level that you're managing your trade from. So those of you who are in that GN or EN trade, just like I am, when you're adding those positions, right? When it comes and touches your moving averages, you drop down there to that 15-minute chart and you add you a new entry, and the market should almost immediately fall. Or, if you're buying, it should immediately go up.
I have a question
We can't hear you.
about,
Is that you, TT?
well, it's for GN and E and how
TT.
it's for any pair, really.
TT.
How you doing?
We can't hear nothing you say.
You hear me?
Now I can.
Yeah.
You sound like Computer Love a minute ago.
Oh my God. What about now?
Yeah, now you good. No, no, no.
Okay.
No. Oh my God.
She about to be Todd Jr. with the internet.
Oh, hey, I don't know, but do I sound like that? Zapping Roger? I thought she had some auto tune on. I'm gonna start calling her Auto TT. Auto tune TT. Did we lose it?
Okay. Okay.
Okay. Well, yeah, ass right there, TT.
Okay.
Well, you can ask in the chat.
Okay.
Well, I mean, nobody, you don't know that, TT. I mean, you're not gonna know, but you're,
Oh shoot.
you she asked, how do we know that the trades, and she's
No,
talking about,
I'm here.
okay. So you're asking about GN and EN going back up to fill the imbalance, right?
Okay.
Let's talk about this.
How do we now back
That it's not going up back up here.
up to
She's still on the delay.
Yeah, let us discuss. All right.
Somebody tell her we discuss.
Okay. So for those of you who aren't trading this with us, GN have an order block right here that's not been mitigated, the zone. We have an order block here that's not been mitigated too. Okay. There was an imbalance. The price came back up and it filled the imbalance. It faked down, came back up, double topped, and it pushed down. All right. So on the 1 hour chart, I had marked up these two swing lows, right? There was a low over here. The wick came down. And then this news candle sent the wick down, right? It sent the price down, but it did not violate this low and it pushed back up. So eventually the market comes back up and it pushed down and we wicked past these lows, right? So I expected to see price push back up to this level before it sold. It didn't do that yet. So there's two scenarios that can play out, right? I'm biased for this to sell since we did break these lows, but this is how I have to look at the market. I'm gonna flip this move from here to this wick, and it needs to pull back into the zone. I'm cognizant of this entire zone right here, right? Now I want to drop down to see what's in this wick. I'll just drop down to the 5 minutes since that's 2 time frames down. And you immediately I see a bunch of imbalance, right? Y'all see that? There's a bunch of imbalance, right? In this wick. So price could possibly come down here, feel the imbalance, and go back up to those zones, which would be perfectly cool. It's within itself. Maybe it's just a liquidity grab on that for these 1 hour lows before it goes up to the mitigation. There was a video that I watched and shared with a few of y'all that talks about this exact thing. It's called inducement. Inducement is something that happens in the market that's designed to get you, it induces you into selling from here. We got a double top. Market pushes down, it breaks the moving averages. Everybody is selling, right? But you got to understand where you're safe to sell it to. So if you were one of the ones that was selling GN like me, that's cool. Hopefully you took your profit, before the market closed. If not, maybe you need to look at taking your profit. If we break this high right here, take your profit, because at that point, I think we're going to push back up into these zones, right? And handle what's supposed to be handled. It doesn't matter. We don't have any control over that. All we can do is look on the chart and see what needs to be accomplished. The first thing that needs to be accomplished is these imbalances either have to be filled and ran through, or it's going to fill the imbalance and it's going to push higher and break these highs, right? And it'll come up to this level. So all you can do is base your reactions off the market's actions. And that's all we're ever going to do as traders. We can anticipate, right? We anticipated this would sell down. It sold down. It broke those lows, but it did not break it with a body. It didn't hold those lows. So I would suggest that you watch this and see if we get a bounce when it fills these imbalances, and we start either breaking highs, or we run through this. We might get a bounce and we break the lows, but you're not going to know until either the highs or the lows get broken. Does that answer your question, TT?
Kind of.
Kind of.
Am I still in computer love mode?
No, you good.
Oh, yeah, kind
So
of.
listen, you're saying because I'll add and get effed up. Why? Where are you?
Yes,
Where are you adding and why are you adding?
at the well, I haven't for this time. I just have one entry at GN, but I mean at when at the MA, I have an entry from the MA on the sell.
The sell. Okay, so it's easy. You're either going to take profit when it breaks this high, or you'll let it roll because it'll break the low. But that's part of trading. You just have to monitor the trade, right? Like you have to make sure
When it breaks the high, but it's what's confusing me, because I'm supposed to aren't I supposed to add a position when it comes back up to the MA for the continuation of the sell? Isn't like
you started selling right here at this moving average, correct?
yeah, but I see that there are also unmitigated things at the top.
But listen to what I'm saying, TT. You have a sell position right here. The price pushed down. It took the liquidity under here. It came back up. If it had closed and held its position, I would just say, don't worry about it. Hold your sell. But because it came back up and made a high right here, this is going to be where I'm moving my stop loss to. Ding. Right? When the market opens, this trade is either going to push down, or it's going to come up and break your high. And this would be my last line of defense. I'm taking profit. I'm getting out here if I'm just in a sell, right? It's only 35 pips, but it's better to take those 35 pips in profit than to let it run back up and put you in drawdown, because this is not a great entry for where price sits right now. Does that make sense?
Okay.
Technically, these lows are broken, which is cool. So I would have liked to see this red candle close as a bearish order block. It did not. I just showed you on the 15-minute chart, or on the 5-minute chart, where you have all the imbalance, right? So as long as this price doesn't bounce from here and go higher, because then you're starting to get higher lows, which is telling you that the market is going to push up, and this will be the next high that it breaks. But your entry is right here. Your entry is right here on the moving average. but you don't want to wait for price to break this high. I guess you could if you wanted to, but I wouldn't do that. I would just take my 35 pips. But I want to see price break this low. Or this high. That's what has to happen first. Right now, price is in the middle. There's zero we can do. I have all sell positions, right? I don't have any buy positions right now because I took profit on those buys. I have all sell positions. I got 3 of them. So if price breaks this high, believe you me, it'll be picking up a hedge, and it'll just be an equal hedge. I'll have, I won't make any money. I won't lose any money. But until price breaks this high, I won't add any buys. Until it breaks this low, I won't add any sales. Does that make sense? So for me, the best thing that can happen is price can come down here, feel the imbalance, it can bounce, make a lower high here, and then keep pushing down. That's the best case scenario for me. That's what I would like to see. That's what I should be able to see because we broke these lows, right? We broke these lows. So maybe price would just retrace a little bit to this level, and we'll get lower lows. That's what I hope to see. But if for some reason price comes back up here and breaks this high, now it's a different ball game, and I got to reassess. And I already have the areas marked up, so I understand why it would happen. But it's just not something that I would like to see happen. Does that make sense?
Yeah. Okay. Thank you.
Yes, ma'am. Anybody else? Anyone.
Don't Jen and Ian move the same? What's it called?
Similarly, they're both euro pairs. I mean, they're similar, but the economy, they don't share the same economy.
Okay, because I'm like, the way that Ian even broke and closed below the previous, all the way down like that.
Yeah, that's what Selena's talking about.
I almost feel like GN gonna follow right behind it. It just want to scare people a little bit first, and then
It would be nice, but it doesn't necessarily have to. Like if you don't have any trade positions in GN, this is a good trade. I mean, I can
it
see.
has no friction next right now.
Yeah, right now
Except Chase.
you just want to see a pullback, and then you want to see it fall off the cliff, which is cool.
Yeah.
That's what I think. I think that's what Selena was talking about there.
Mm-hmm.
Anybody else? Fer, ¿entiendes?
What?
What?
Why y'all saying what?
You need to work on your Spanish dialect, buddy.
Bebé, ¿entiendes?
Oh, entiendes.
Exactly.
Y'all,
Need to help.
I was like, what language is that?
y'all don't know what entiendes is?
Preguntas.
Entiendes? No más. Yeah, no más.
No más. That means no more.
No more.
No entiendo.
You don't know.
So everybody's straight. Everybody's good for for what's coming up.
Well, if Jen decides to buy or both, either one of those decide to buy, let's say if Jen decides to buy, I think I'll just be looking at another pair because it'll just go against my analysis. I feel like unless
What is your
unless
analysis?
it's just buying to the unmitigated area, and then I'll wait, and then we'll be waiting again for it to close below the MAs,
Yeah.
or
Definitely.
or would it be an aggressive entry with a hedge at the top of the structure?
Well, I mean, I would wait for it to close below the MAs.
On the 4-hour.
Well, yeah, for you, yeah. For me, no, I'm not waiting. But yeah, for you, I would definitely wait. I mean, I'm just going to use the structure if it buys up to my um areas, right? Because once it hits your area, you drop down and you wait to see a chop, right?
Okay.
I mean,
The
some
close below the 15, or
so if price pushes into that unmitigated order block and it gives me a chalk, I'm selling it. Now, if it's a 15-minute chalk, I have to sell it to a 15-minute target, right? And if it gives me a chalk on the 4-hour, then I can get a 4-hour entry and sell it to the 4-hour target. Does that make sense? Do y'all know the difference?
yeah, the bottom of the structure, the bottom of the next low on the 15-minute, or the bottom of the
There
next
you
low
go.
on the
There you
4-hour.
go. I feel like that Rosebud probably explains this a lot better. But yeah, that's exactly what I mean. If your chalk is on the 15-minute, you can sell it to the low on the 15. If it's on the hour, you can do it on the hour. You can't take a position on the 15 and try to sell it to the 4-hour low. I guess you can try it, but don't be surprised if you get burned up doing it. Fur, ¿por qué te ríes?
Because your Spanish is very good.
Ah, gracias.
Mhm. Yep.
All right, so everybody's tracking. Everybody, did everybody do their analysis? Would anybody like to share a markup? Come on, Brett. Come on, come on. Come on, Lee. Prince shared his markup last week.
Let me see what I got. I don't want to go first though.
You the one that's qualifying accounts. You might as well go first. I'm trying to see what you see.
Mhm.
From a structural standpoint, I like EN. From a pip count, I like GN.
Right.
No new recordings. No new recordings.